be mindful of everyone's time. My name is Patrick Gardner, and I'm a loan officer with Guarantee Mortgage and Vice Chair of the Education and Events Committee. On behalf of the committee, I'd like to say welcome to our mortgage update with our camp leaders, California Association of Mortgage Professionals. As we get started with our webinar today, I wanted to share some logistics for our meeting. All Zoom audience members are muted through the entirety of the presentation. The webinar will be recorded and will be available on the SFAR social video library on tomorrow or the next day. Audience participation is welcome through the Q&A box. So if you have a question for our presenters, please ask it through the Q&A box, not through the chat feature. And I'm going to jump into our bios for our presenters. Joining us today is Audrey Balsano. She's the current president of the California Association of Mortgage Professionals. In addition to being a sales leader for Guarantee Mortgage in the Bay Area, she's a 30-year veteran in the mortgage industry and passionately driven to ensure her clients achieve the American dream through home ownership. She is a major client consumer advocate and has vast array of industry experience at both the state and national levels. She has won numerous awards and also holds leadership positions in other industry associations. When not working, she has many outside interests and is married with 3 wonderful kids and her beautiful dog, Stella. Kevin Casey is among the top loan officers in the Bay Area. He's built his business almost exclusively from referrals of clients and colleagues and is regularly quoted in the Oakland Tribune and other media sources as a knowledgeable mortgage pro. He is also president-elect for the California Association of Mortgage Professionals, AKA CAMP. We welcome Kevin and Audrey today, and they're going to talk more about the current mortgage landscape under the shelter in place and the COVID pandemic. Thank you guys for joining us today, and I'm going to go ahead and turn it over to you.
Thank you so much, Patrick. We really appreciate having the opportunity to be here and answer questions because our industries are completely connected and tied together. So what impact mortgage business impacts real estate and vice versa on almost every level. So please feel free to ask questions and let us know what you're wondering about or what you've heard or what you'd like to know about. So we thought we would start with appraisals. Kevin, do you want to?
Sure, that's one of the questions I've been getting from a lot of my realtors. It is an issue. It's not as much of an issue in San Francisco per se. Values seem to be holding still. Although I was talking to one lender, it was an investor, private money lender, and he seemed to be concerned about San Francisco values. But for the most part, I'm seeing values hold. Right? When I'm doing my appraisals in San Francisco, the values are holding in place. We're not seeing any decline. But I have talked to other mortgage lenders around the state, and the big issue is when an appraiser decides that a value or the market is declining, he has to click a box on that appraisal. If that box is clicked, that's the serious problem, because right off the bat, the lender is going to knock down the value by 10% right off the bat. So let's say you have a home, it's in contract for $1.5 million, and the appraiser thinks that values are going down, and he feels it's not worth 1.5, it's worth 1.45. But then he also checks off the box that 10% decline, or that the market's declining. The lender is going to knock another 10% off that value. So that's a current problem in the mortgage world if it happens. What we've been dealing with, we're fortunate enough we can switch lenders or banks. We can order a new appraisal, get it done. We're not, a bank like Chase or Wells. If that happened to them, that's going to be a much bigger problem because they can't just easily switch and order a new appraisal. So we can contest it. That's the other option. We have a whole appraisal review department, and we can do it. This is my own company. Other bankers, brokers, we all handle it differently. So a broker is going to maybe flip it to a different lender and order a different appraisal. The bank is probably just going to decline it or try to work with the loan to value. Loan to values, that's another issue. Audrey, I don't know if you want to talk about that, about how some of the lenders have cut back on their loan to values. Chase, for instance, they would do 85% loan to value on a jumbo loan up until a few weeks ago, and now they're only maxing out at 80%. So that's where we're running into a lot of more issues on that side.
I just want to jump in with to finish up the appraisal part, where I've only had one appraisal come in where the appraiser indicated declining values, and I rebutted it and won. So do not just accept that kind of thing lying down, because again, I am based in the East Bay. I lend all over California, just like anyone who's licensed in California, but I am not seeing declining values. I'm seeing multiple offers on almost every property that goes into contract. There is limited inventory, and there is a pent-up demand from buyers. And so I believe that when appraisers click that box, they need to be corrected. And when you are trying to rebut something, be an active participant in that process. Help your lender to provide data, because we're going to need to provide new data to the appraiser, to the AMC, so that we can say, okay, you can't just say, oh, you were wrong. You have to say, you were wrong, and let me show you how. So be prepared to be an active partner in that process, but it is possible to get back some of what you may have potentially lost. So again, the first response, in my opinion, would be check out the data and see if they're wrong. And if they are, fight it.
Cool.
Yep. So, and yes, let's talk about loan to values, because that keeps changing, right? So we had a pretty steady decline of options and programs that went away, and guidelines were changing, and they were getting more stringent, and investors dropped off. Entire segments of the industry seemed to disappear overnight out of nowhere. And what has been happening, that was for the first, 2 months, 200 years, that's how it felt. And now for the past 2 to 3 weeks, we are seeing things go in the other direction. So that would be the good news of all of this, is that guidelines seem to be loosening up. The FICO restrictions are easing some, so that, before there were lenders who weren't lending unless you had a 700 FICO, et cetera. Now we're seeing that ease off a little bit and get a little more, not back to where it was, but we're headed in the right direction.
Yeah.
So, and then let's talk.
Search is the big one that's still tight. This is where I'm seeing problems in jumbo loans.
Yes.
And where before I can get away with 6 months in reserves. So that's for those who don't understand lender talk. Let's say their mortgage payment's $5,000. You times it times or taxes, insurance, everything. Let's say $10,000. Make the math simple. Then they would have to have $60,000 or 6 months. Now the lenders want 12 months. So that's $120,000. And then some of them are tightening up like the rules on the retirement money you use. So that's all makes it a little challenging. So, the loans we have are like just where they're like, oh yeah, we can do this easy. Now suddenly they're really difficult. And then also on the underwriting on jumbo lenders, Audrey was sharing a story about how she had to fight with, an underwriter. And I just finished. It's a battle. It's a complete battle. The underwriters do not want to sign off on a jumbo loan where the lender is lending $1 million. The call we just got off of, the old adage in the mortgage world is that if you borrow $100,000 from a bank and you can't make your payment, you have a problem. If you borrow $1 million from a lender and you can't make a payment, the lender has the problem. And so you got to think about these banks. They're lending, millions of dollars. It's their money. It's not the government money. So it's a big problem when the payments can't be made. So that's why it's much more a challenge on the $1 million deals.
Well then, and also know that the lenders are extremely aware that the markets have changed, that people's account balances have changed, investments have gone down. They are, and that people have lost their jobs or have been furloughed or taken job or payment hits, income hits.
That rolls into the big one is employment. I mean, that is the verification of employment.
Well, that's right. That's where I was going. Is do not be surprised, and make sure you're setting the expectations for your borrowers and help the LO do it. Hopefully you're working with someone who does this very well. But again, be a partner with them, because the borrowers need to hear a united message, which is everything has changed and we can get this done. However, we all need to be working as a team. So at the very end, they are going to verify, re-verify employment. It is very important they understand they have to make their first payment and that they do not ask for forbearance before they do that. Otherwise, there is an unsaleable loan or a loan that has a huge penalty when it's sold on the secondary market, which impacts all of us ultimately. And then they may be asked to re-verify that their account balances have not decreased. And so again, the old days where we all used to shield our borrowers from anything unpleasant or any sort of, oh, everything's going to be fine and easy. No, let's just go in up front, and you don't have to scare them. You just share information and make sure that you are setting the proper picture of what to expect. So when it happens and you're asking, or they're being asked to provide this updated documentation at the end, that they're not surprised, they're expecting it, they're looking forward to it, they know they need to keep you up to date as far as their employment status, their investment status. All of those things matter all the way to the end and beyond. So again, it's just a function of making sure that you communicate. Everyone's communicating throughout the process.
Yeah, and don't be surprised to hear from your borrower that we have to verify their employment 4 times during the process. And 3 of them right at the close. It's kind of crazy, but that's just what we have to do.
It sounds crazy. And self-employed borrowers, again, like they have a whole different thing that they have to go through, where a lot of investors are asking that they show that they are still receiving income, because they know that a lot of businesses have been closed for 2.5, 3 months. And so again, nothing is going to get by these investors. If they don't find out now, they're going to find out later. And either it's much better to deal with it up front and make sure that you have presented your borrower properly and that there aren't any ugly surprises either right before you close escrow or afterwards, which is also not a good situation.
Yeah, no, the big one that a lot of people don't understand is if a borrower requests forbearance after the close of escrow, that the investor that made that loan and has that loan on their books, the servicer, actually the servicer is the one that's got the loan on their books. They have to make the payments for the mortgagee. And not only the mortgage payment, but the taxes, the insurance, all that has to be made on behalf of the mortgagee. That money has to be put aside. And that's what's caused a lot of the liquidation problems or liquidity issues right now in the market, where the big banks are literally having to put aside, they were estimating 30 to 40% of their money towards this. Now, and as the numbers are rolling out, the numbers are under 20%, so it's a lot better. In some cases, they're down under 10% for the forbearances, because while a lot of people requested forbearances, only the stats we're looking at this morning, in some cases only FHA or Fannie and Freddie's, only 6% of the people are actually in forbearance. So those stats are good, and so that's why you're seeing those numbers come down. The jumbo numbers, the non-QM, as we call it, non-qualified mortgage, those are not as good. And again, hey, you've got a big mortgage, it's a big problem when you can't make your $10,000 payment, and it's a big nut to crack every month, and suddenly the income dries up. It can be an issue. And in this current market, there's a lot of borrowers that are suffering just because, the average borrower that borrows $1 million is pretty sophisticated. They usually have, when we're doing our loan applications for these borrowers, they have rental property, they have some side businesses going, they have commission income, bonus income. Their tax returns are not simple and in the slightest. Sometimes S corps and other corporations that they own or run. And unfortunately, when things go bad, they tend not to go bad across the board, not in just one isolated area. So it's not uncommon for them to all of a sudden, everything dries up on them, and now a $10,000 mortgage payment is a challenge. If you only had to pay a $1,500 a month mortgage payment, I have it in savings, not a problem. So the other issues we're dealing with, rates, that's the other one we're getting all the time, is jumbo rates, because everyone's hearing how low interest rates are. If I locked a FHA loan last week 2.75% on a 3% down 2-unit purchase. Crazy, and it's insane rate of, with that little bit of money down. But FHA, that's government money. When I go to lock a jumbo loan, I'm looking in the high 3s and sometimes in the 4s, and it can get into the 5s and 6s really fast if little things go wrong, like a credit score or a reserve requirement isn't met or anything like that. So that's a big issue, and that payment jump is pretty big.
I would also, again, it's all about setting expectations with regards to rates. So a lot of these programs, as they're coming back and the guidelines are opening up a little bit, there are loan level price adjusters, or there are extra charges that the lenders are putting on a loan based on what they think the risk will be. And so just always remember that loans are priced based on the perceived risk or the risk that the lender has calculated using whatever algorithms that they have chosen to use. So again, setting expectations with the borrowers. When you are looking at a contract and a borrower, and let's say you got 8 offers, which I'm seeing, which offer do you want to take? So you really need to ask good questions of your loan officers. So when you're looking at the pre-approval letters, pick up the phone and call them, talk to them. I have somebody who had gone into contract. They had gone in contract with a big bank and were all the way through and had signed their loan docs, were 4 days away from closing. And all of a sudden the big bank said, nope, we're not closing your jumbo loan. And so we had to pivot. They had to pivot and go with a lender who could do a first and second combo. And that was the way they solved their problem. They were very lucky that they were able to do that. So, ask good questions and really remind your borrowers, this is not about chasing the lowest rate. This is about doing a balanced assessment of what is the rate, because obviously everyone wants a good rate. I've never met, I have one client in 30 plus years who said, don't really care, cost of doing business. Every other person I've ever done a loan for, of course, everyone wants to get a good rate. We all want a good rate. Got it. So good rate, very important, but also critically important is, how do they handle appraisals? What is the underwriting process like? I got a new borrower on Friday who was at a bank who had gone all the way through the underwriting process and was then told that they were not going to do a cash out refinance on a jumbo loan for a perfect borrower with a ton of equity. So again, you have to have conversations with your borrowers, with your buyers and your sellers. The sellers also need this education. They need to understand, okay, I understand that I got this super high offer. How does that balance out with the other offers I got? And, if somebody gives you a really high offer and you have a really long contingency period and you have, less money down, et cetera, that can be a little risky. So make sure you're really thinking through what are the risks, talk to the lenders, make sure that they sound like they at least know what they're doing, and that hopefully they have like a plan B stuffed up their sleeve should they need it. You don't want them to, but you want to know that they're going to be able to pivot quickly and figure out something else so they can get your transaction closed.
Yeah, a great question I get occasionally from a real estate agent when I've got a client making an offer, I'm pre-approved, and a lot of times I'll call the listing agent, but sometimes I get the calls from the listing agents, which are always great. And my answer usually when they ask me, hey, what's your plan of action? And I go, I would never say I can do this loan unless I know I have a backup. And sometimes I have a B backup, a C, and a D backup. Because, I'm in the middle of a deal right now, purchased down in San Jose, $1.5 million. And the lender I was going with suddenly dropped their maximum loan amount to $1 million. Well, that's a problem. Fortunately, I have, 3 other backups, and we quickly, pivoted and going with the lender that'll go up to the $1.2 million we're looking for. And so we're okay. But it's like, if I didn't have that backup, I'd have been really putting my clients at risk because I can't control the market. I can only adjust and pivot when things happen. So it's just ask that great question. It's a good question to ask your lenders.
So I think it'd be worthwhile to go back to the forbearance conversation just to cover where we are now. And we've come a long way since they first came out with the forbearance options. So I just want to start with saying that even though we've had issues around the forbearance options that were presented to us, the great news is that this time there were forward-thinking people who were interested in keeping people in their houses throughout this crisis, knowing that when we were going to have 40 million people filing for unemployment, that maybe people potentially might not be able to make their mortgage payments. Okay, so thank God for that. That was great. The fact that they didn't seem to understand the entire process and the ramifications of what they were saying up front were an entirely different issue, which we've tried to work through in the last 3 months. So it started off as, it sounded like the message was, don't worry about making your payments, you can ask for forbearance. And then the banks were flooded, or the servicers and the banks were flooded with phone calls. Nobody really knew what the guidelines were. They weren't sure how it was going to be impacting people's credit. It was just the CARES Act spelled out a few things, but the devil's in the details, as always. So we've really had to work through answering those questions in the last few months, and we really are answering them now. And we're starting to see what it looks like on somebody's credit report and get clarification from the agencies on how long do you have to be out of forbearance before you can refinance, et cetera, et cetera. So just
or
know that
purchase.
Pardon me?
Very important. Or purchase.
Thank you.
Your
That is
forbearance right
absolutely
now on a current loan.
That's right.
Your purchase loan is not going through.
That is correct. Okay, so or if somebody, yes, so absolutely correct on that. So with that being said, just a reminder that forbearance policies are different depending on whether you're doing a Fannie Freddie loan through FHFA, whether you're doing an FHA loan or a VA or USDA through Ginnie, or if you have a jumbo or non-QM or some other private investor. Those, not everybody has the same rules. So there were some people who thought, oh, I don't have to make my payment. They thought it was a free pass. It absolutely was not. Everyone is still on the hook for every penny that they owed. And so it is critically important that borrowers call their servicers, ask a million questions, and really understand what they are agreeing to, and understand that it is not a free pass. So I had some potential borrowers call me, and they are both self-employed, and they were both not working during the initial parts of COVID and shelter in place. And they had always paid off their credit cards every month in full. So their concern was, how do I do this? I can't make my mortgage payment. I can just do a forbearance. And they thought that was the easy answer. And I said, if you can make your mortgage payment, you make your mortgage payment. That has to be our messaging, because it causes all sorts of issues on the other end, regardless of whether they're planning to do a refinance or a purchase down the road. So you make your mortgage payment, and our agreement was maybe this month you don't pay your credit cards in full. That's a better option than not making your payment on your mortgage. So what's been really interesting throughout this whole process is they were staggered by the number of forbearance requests, and a lot of people actually entered into forbearance, but the number of people who are actually making their payments, and Kevin started talking about this earlier, was most of the people are trying to make their payments, which is great news, because on the servicing end, and again, going back to the liquidity issues and what is impacting rates and programs and lenders, is can they model for what's coming? And nobody ever could have modeled for a pandemic. Well, we might have guessed, but nobody did, model for a pandemic and then a government policy that involves don't make payment. So that is something that is, as they are providing more clarity around how it all works, how it all fits together, when they're putting balances into place. So for instance, FHFA came out and told servicers, listen, you cover the first 4 months of somebody being in forbearance, and we'll cover payment 5 through 12. Okay, that changed everything, because then they can model, then they can see what their worst case scenario is, and they can plan accordingly, which provided some relief in the market, which was great. So that's where we are right now. It continues to evolve and we have been jumping up and down screaming from the rooftops, us and NBA and National Association of Mortgage Brokers, we've been advocating for the consumer and the realtors and the lenders so that the powers that be understand what their policies mean and how they translate on the street. So that's where we are on that.
Want to talk about legislative stuff?
Sure. So one of the things that we do at the California Association of Mortgage Professionals, just like California Association of Realtors, is we advocate in Washington, D.C., Sacramento, and more we're realizing how important it is to do it at the local level. So in the last year, both Kevin and I have testified or spoken, I guess is a better way, in front of the California Coastal Commission, which, I mean, who knew what they were up to? I mean, so again, it's such an education when we're doing all of this. And lately, we have been interfacing with city councils who have taken it upon themselves to expound on the policies that were put forth in the CARES Act and issued by the state of California, and even make them broader. And typically, those are not helping homeowners, landlords at all. And so it sounds good. A lot of their ideas sound good on the surface. And you would think, oh, of course, I mean, it'd be great if we didn't have somebody, if we had a policy where someone couldn't be foreclosed on for 5 years. But the reality is, if that is the policy in the state of California, the lenders will stop lending here, or it will get so outrageously expensive that it will halt lending and real estate. So to say that we are all over these kinds of issues is putting it mildly, and more we're working with other organizations like California Association of Realtors. It is really important that we team up, and that when you as an industry, and the realtors are great at staying on top of issues. They have a lot of money, they have a lot of members, they have a lot of paid staff. And so they, and the staff that they have are wonderful. I mean, the people I've been working with are just incredible and such a great resource, and really willing to band together to make things good for our industry. And what's good for us is what's good for our borrowers. Typically, we're not asking for things that are going to make our lives better and easier. We're asking for things that are going to help our borrowers, our investors, the homeowners, the property owners. And that's what we always need to stay focused on. But it involves the voice of our industry being heard. And that means that if realtors can be involved, I mean, if you have a mortgage person that sends you a call to action for the mortgage side, fill it out. You can send it to your relatives. You can send it to the guy who came to your garage sale and left you his email address. You can send it to anyone that you want. They don't have to be members of the association to chime in and have their voice heard. So again, the more these politicians hear from us, the better, because let me tell you something. The tenants' rights groups are extremely loud. They are very, very well run. They are funded somehow, and they are shouting from the rooftops that we need to be providing a lot of resources for tenants. And it's important that we do that in a balanced way that is not impacting the homeowners and investors, and that we aren't asking private industry over and over to fund public, what could potentially, and in my opinion, should be publicly funded resources for people.
Yeah, no, the statistic we heard this morning was that in San Francisco, the delinquency rate on rents was extremely low despite all of this. It's in the 3 to 5% range, which is not too far above normal. So despite all of this, San Francisco tenants are still making their payments. So are California mortgage borrowers. The vast majority are making their payments, and so that's the good thing.
It's a great thing, actually. And we're hearing stories. I have an investor who told me that when this all started, and this is a guy who went through 2008 and frankly lost everything and had rebuilt since then. It has just been a celebration every time that he achieves some other milestone. So he's bought rental properties, bought a house, he's done, he's really built his company well back up and is doing great. His approach was he contacted his tenants early on and said, if you are having a problem, let me know. I'll work with you. He was just really proactive about it. And do you know that every one of his tenants has paid their rent exactly? No, we're good. Thank you though so much for asking. And so again, this is not about us versus them. This is about all of us banding together to make sure that the market is healthy and whole. Our borrowers are healthy and whole at the end of this. So it has been quite the few months, but it feels like we're coming back out on the other end of it, and that we're headed in the right direction. Jamie Dimon, who heads Chase, just made mention that he believes that the recovery is going to be a V. And when they're talking about these letters, it was a completely new concept to me a couple months ago. Sorry, it seems like 300 years ago, but it was really just recently when they were talking about what kind of recovery is our economy going to have. And one of the options is a V recovery. As we all know, our economy, the bottom fell out of it, right? So we went from here and then we went down to there. And so a V would be is if we went right back up. And that is what he is suggesting might be happening. Again, it is all going to be very dependent on how fast we can come out of shelter in place. What do the COVID numbers end up looking like? I mean, never mind the riots and the fact that I'm sitting in a boarded up building right now in downtown Walnut Creek, where we've had our own share of nightmares the last few days. So, but again, back to the mortgage market and the real estate market going into this, what they're saying is definitely a recession. We just don't have the numbers yet. We had a really healthy housing market. So housing was as strong as it could be. We had more demand than we had product for buyers to buy, and we have a housing shortage. None of that had been fixed or has been fixed. In addition to that, we have a tremendous amount of cash in the market, and we also have people who are very well qualified for their loans. So for the most part, unless somebody loses their job and is without income for an extended period of time, people are going to make their mortgage payments and they want to keep their houses. They don't want to lose their houses. And again, as a whole, we have indicated through the CARES Act, et cetera, and all the subsequent legislation that they've done and the different programs they've put in place, that there is an interest in keeping people in their homes. And so, and that to me, those of us who are on the call right now, we went through the 2008 nightmare, and it was just a never ending, it was just the pasture of pain, and it was long. So, it was like somebody ripping out the Band-Aid, whacking you in the middle of your sore a few times, and then you start to heal. And that was just like a festering wound that never seemed like it was going to end. So this is much better, at least from right now. That's how it's looking. Sadly, the number of people who lost jobs who are making nationwide less than $30,000 a year is huge, but they are typically the renters. And so again, if we can help them stay in their places and pay their rent, which some of the programs have done, then we're going to be okay. So,
right. And people making under $30,000 a year are not buying homes in San Francisco,
or anywhere in the Bay Area, frankly.
Yeah. So that's the other thing too. And the other thing too is there is going to be the biggest boom in real estate once we get through this. We were watching, we had Barry Habib with us interviewing a couple of weeks back, and he's a big guy out of New Jersey, and a lot of mortgage guys follow him. And he was saying that, give us statistics, the average millennial right now is about 30 years old, and they're about to have their first kids. They're coming up on first baby borns. And the number one reason for home purchases in the United States is first baby, either on the way or just born. And what are we just going through now? We're going to shelter in place where all these 30-year-olds are cooped up in their little apartments. And apparently we've got a huge baby boom coming. And so I think, get busy. And I'm telling all my clients, buy now, buy now. Don't take this as an opportunity. If you knock a little bit off the price, you get a discount because the sellers are scared. Take it and run, because this is not going to last. It's going to be, we're going to look back on this like, oh my God, that was the one opportunity to buy real estate in San Francisco. And, I'm seeing stats that, the next 3 years, we're going to see 38% increase in values in real estate in the Bay Area. And that's massive. And you put this in perspective. You own $1 million home, it's $1 million home, and let's say you're paying $10,000 a month in. Well, you wouldn't be paying that much. You'd be paying about that's $7,500 in your property insurance and taxes. Your value is going up by $10,000 a month, and your mortgage payment is $7,500 a month. It's a no-brainer. Buy real estate. The value of the home will go up higher than what you're paying for it. So that's huge.
Well, and those, even if the numbers aren't that large everywhere, that is, it is a fact that you're going to do better if you own a home. Typically. And also in the last few weeks after we had, obviously we were all completely locked up in April and March, much of March. And so the numbers in the last 2 to 3 weeks that are coming out with regard to purchase applications, the numbers keep climbing. So again, pent up demand, you have people who have been, like Kevin said, cooped up in their places and are realizing that we need more space and we need we need to buy something. So there you go.
Yeah, I'm actually getting more calls for purchases right now than refis. So it's starting. Yeah,
that's great. So Patrick, are there any questions that are coming in?
So I got one or two questions, and I just want to echo what Kevin was saying. Literally Monday morning, I got a call from a new client who was 6 months pregnant, 30 years old, and looking to buy. So that's remains.
And the other one I didn't even talk about is the other thing that causes the need for housing: divorces.
Yeah.
That's the other ramification of what we just went through. So you got lots of babies coming on and lots of divorces. There is going to be a super shortage of housing coming up in the next 3 years or so.
For sure. All right. Well, I want to again encourage the callers and viewers on the call to ask questions through the Q&A box. One question we got so far is, what's the difference? And I'm kind of paraphrasing this. What's the difference between like a retail bank scenario, Chase, Bank of America, Wells Fargo, and the kind of broader spectrum of a mortgage broker? Like, so if right now, how is this impacting retail banks as we're saying it versus the mortgage broker side?
So that's an interesting question, and it probably depends to some degree on which retail bank you're talking about. I had a conversation with someone who works at one of the big ones yesterday, a very long conversation. And he is basically pausing right now because they used to have like a price match for rates, and that has been suspended. And they have pulled way back on their guidelines as well. So if you fit into their box and are very assured that somehow you fit into their box, then that would be fine. And sometimes they're able to provide a lower rate than somebody else. However, if you are at, let's say, a mortgage broker or a mortgage banker who allows for brokering and has multiple investors on their correspondent side, then you would have the ability to pivot and go to plan B should you need to. And again, the other thing too is that the appraisal part of this is very important. So you want to make sure that whomever you are working with has a very good, broad, qualified group of appraisers who are going to be able to give you values that are solid and in the market and not super conservative. So we're hearing anecdotal stories from people who are telling us that there are some lenders who are using very conservative appraisers, and they are coming in under value, and you don't really have a recourse in that situation. It's you either fit in their box or you don't fit in their box. And so again, some of the lenders are great, and but it just depends, and the turn times are long. Like their idea of quick is not my idea of quick. But if you have somebody that is insistent that they have to have this particular rate, that might be the only option you have, and you just cross your fingers and say a prayer and hang on.
Yeah. I mean, if the clients have money, you know, a lot of times the banks are the best option for them. I see it all the time. Where I have a client and, you know, he has a couple $1 million in the bank and he's banking with B of A. And I'm like, why aren't you talking to B of A? Because
but they have to have money, and they have to have really cookie cutter financials.
Yep.
For the most part. And a lot of times what we're also seeing is that these banks are asking for them to shift a tremendous amount of their assets to that institution. So one has to ask, okay, so if I have my investments over here and I'm making X return, but now I'm being asked to put them into this other institution and my return is either going to be lower, I will have less options, et cetera, is it worth it? So,
but you do the math,
but the super tight guidelines you got to watch, because again, if you hit a snag, for instance, I had a friend who was in the business. She did loans, and she went to one of the big banks. I almost slipped and said their name. Anyway, she went to one of the big banks and to do her own loan, and it was quite the experience. So for instance, they looked at the bank statement and saw that she had pet insurance and wanted to add that into her DTI. And the pet insurance had just rolled over like the year, and the amount had changed. She had to cough up contracts, and I mean, you know, for somebody who's tight on the ratios, I mean, good God, you add another, you know, $80 in there and you could be dust. And so is it worth it? I don't know. Like, you have to make that decision. Your borrowers have to make that decision. And I know some great guys who work at the big banks. So they're really good loan officers, and they're really good people. And so it's not that, you know, one person's better than the other, but it's just the number of options, and have that conversation early. And I was startled and not excited about my client who came to me because they found out from the underwriter that a program had been canceled. Like, why didn't their loan officer know about that and let them know ahead of time? So you just want to make sure you're working with the right person. It's not usually institution based. It's usually, all right, who is the person on the ground who is running your loan for you and your borrower?
Thank you very much for that response. Next question, it's more on the real estate side, but the viewer would like your opinion. Some of her buyers are waiting and thinking that more layoffs are resulting, that maybe, as Janie Dimon said, this isn't a V, but more like a W. In response, what would you say to holding off? I think, Kevin, you said something to this earlier.
I would say, as a buyer, why would you have your buyer wait for more buyers to come into the market? All the projections we are seeing is that we are forecasting, or all the experts I said, they're forecasting a super strong spring buying season. It just will be a few months from now, in the middle of summer. We're going to see the strongest summer buying we've ever seen. Here's the projections actually in the lending world. We're lending at record rates. Patrick and we happen to all work at the same company. We funded $100 million just on the 4-day week of Memorial Day. We did that much money all of April last year. It's 1 month. We closed 1 month of income in 2019. We closed that in 4 days just last week. That's the kind of volume we're dealing with on the lending world. It's going to get greater. The projections are for the mortgage world to do $6 trillion in mortgages over the next 3 years. $6 trillion. The most ever in the history of the industry is like 1.5-ish trillion dollars in a year. And we're going to do basically double that every year for the next 3. So, things are changing, and the volume is going to be just crazy. So I'm trying to tell everybody, get in now, buy now while you still can, because it's, you're going to see everything's just going to ramp up. We're going to see buying and lending like nobody's business in the next 3 years.
I would echo that and say that you generally will lose more than you gain if you wait. There are no certainties, obviously. I mean, I mean, as we've seen recently, things change in the moment so quickly, it's crazy. However, there is no projection that I am watching, seeing, hearing about that says that values are coming down in our area, especially. So always remember that when you're watching any sort of update, don't take national numbers and think that that is what is true in San Francisco or anywhere in the Bay Area. It is, we have our own little world that we live in, as we all know, and our values do not necessarily mirror the country's. And so again, we're putting people into good loans too. So if somebody's buying a home and a place for their family to live, and we're talking about historically low rates, whatever they are, and don't let anybody tell you that a 3.5% rate isn't amazing, then they should just do what they need to do for their family. And again, there's so much pent up demand right now that I don't, you guys are the realtors, you tell me. I'm not seeing anything that's making me think that values are coming down anytime soon.
Yeah, I would potentially say the opposite. Okay,
Great.
so we got a couple more questions here, and hopefully we'll get a few more as well. So I'm going to rephrase this question a little bit. In regards to some of the more creative means by which to calculate income, say if people do not have tax returns or not self-employed borrowers with active profit and loss statements and things like that, what programs are out there still, despite what's going on with the liquidity in the market? What is still available for borrowers to use as programs?
So we're,
My man, so
what?
I was going to say, may you want to take it or me?
Oh, well, we've been exploring this a lot recently. So we did a non-QM panel. Okay, so seriously, I have no concept of time anymore. Was it a week ago or 2 weeks ago?
It was last week.
It was like, okay. So we did a non-QM panel and we'd been waiting.
QM is non-qualified mortgages, which means you're not using your traditional ways.
That's right. So you're using bank statements or you're using other methods to calculate income, something that doesn't fit into the A paper, Fannie, Freddie, typical jumbo box. So they are coming back. So the bottom really dropped out of them for a while. And at this point, they're coming back. The loan to values are a little more restricted. The rates are a little bit higher. And and somebody likened it to non-QM 3 years ago. So it's an ever evolving market, but you can do a bank statement loan right now. Just remember that if your borrower is self-employed, which they typically have to be for these programs, and they haven't had income for the last few months, then you're going to have to show that they do have income, and that's going to be calculated into the average. But the programs exist. It's something we can do. So again, it's all based on risk, and the clients need to understand that, and that the rate will be impacted. But they can still do a loan. They're just going to have bigger down payments and probably show more reserves. Do you agree, Kevin?
I agree. That's that's my world of the non-QM. That's pretty much where I made my change last year. And March 16th, we suddenly just saw all of that market just disappear overnight. Over like 3 days, all the investors pulled out of it. And now, 2 weeks ago, they started, three of the four main investors in this world started coming back in. There's money starting to flow into the world. But exactly as you said, it's not where it was right before this all happened. It's where it was 3 years ago. So there is stuff that can be done where, tax returns are tight or something like that, but not as much yet. But that will change. That is slowly opening up again. So.
Great, guys. Thank you for those answers. All right. So got a couple different questions here, but the one I think is most important to address is, what can be done for a client that is unsure of future employment but wants to purchase a home? Now, it's a difficult question to answer, right? It's going to be an individual perspective, but I think the question is, can we buy even though we're uncertain? And I think the question may be phrased a little differently. Should they buy?
Should they buy? I mean, everybody, when they're buying a house, I mean, I know it myself, we're commission income. When I bought my house, I went through the ramifications. Okay, so I buy the house. What happens if I had a bad spot? What are my backups? If they've got good cash reserves, well, then they can work their way through, or they have, or maybe it's they have a good family backup. Sometimes the biggest people that bail out most people when they get in trouble is family. So having a huge family and that kind of stuff, maybe that could be. But if you don't think you're gonna, have a future income, then you shouldn't be buying. Although, I heard someone one time argue that owning a home when you lose a job is much better than renting a home, because if you don't make your rent payment by the 5th of the month, you got 30 days and you're out. If you buy a home and you can't make your mortgage payment at the end of the month, well, you can go 3 months without making a payment, and then you can, make it up. Now you get bad credit, but at least you get to stay in the house for 3 months, and now you can extend it up another 6, and so I don't advocate that, but from a
I would say that if somebody has, like Kevin said, reserves and a plan B, that they
CCD, yeah.
CD, yeah. I mean, I think that you go into buying a house with the idea that you're going to make the mortgage payments and that you're going to be scrappy. And if you don't get income from one source, you're going to get it from another source, and you're going to keep on going. You have to make your mortgage payment. So again, it is very individual. It definitely depends on who the borrower is, what their resources are. So as long as they think they will make the payment, that's what they need to focus on. Will I make my payment regardless of where my income is coming from or what the circumstances are?
Excellent. All right, we have time for about 1 or 2 more quick questions. I don't know if this answer is going to be quick, but we'll ask it. With the shift happening for employers who are moving from in-location workplaces to at-home work, do you see values changing, price affecting certain areas more than others? Do you see a run from urban areas, or is this again more temporary? With your crystal
I
ball.
think that,
Yeah.
okay, so quick. Yeah, when Patrick says, and this needs to be quick, he's like, shut up, don't say anything too long. Okay. So with all that being said, I think we'll have to see. I definitely think that there are certain people who want to continue to work in an office. I know I'm one of them. I know that there are other people who are saying, I have a client right now who works for Twitter, and he just is buying a place up in, I don't know, somewhere north-ish. And because he doesn't have to be here all the time anymore. But I think that we're going to have to see how it shakes out. The jury's really out on a lot of these questions. I think it will change things, but how much, that's the question.
Great. All right, so the other questions we had, we're just going to quickly go over. I think Kevin mentioned earlier that some of the jumbo loans, if not, so people have an idea of that they can borrow, they go in, we tell them, or their loan officer tells them the best case scenario, and then it turns out that they don't have the proper reserves or FICO score to get those best terms. How would you help guide them going in for what to expect, particularly in the jumbo area, jumbo space?
That's a conversation that, I have with my clients when I'm dealing with them. It's like, I have someone right now that, hey, we really want 3.75. I'm like, that's it. You can get that. And they're like, well, can we get 3.5? I'm like, no, that's unrealistic. It's, in your particular case, this is what we're looking at, and the numbers work, and, let's just get the deal closed. Let's get you in the house. Because bottom line, what's more important, the 3.5 and the deal falls apart and you don't get the house, or 3.75, you get the house and don't lose out on that house? Because it's the house is the most important thing. Closing is the most important thing. Closing on time, it's the other critical part.
The fixation on rates, I think, is something that was perpetuated as they were trying to commoditize our industry, but there's so much more that goes into it. And I believe that payment is so much more important than rate overall. People, does it really matter? You're not making a rate every month, you're making a payment. So can you make your payment? And often the difference between 3 3/4 and 3 1/2 is not huge. There are certain situations where, you know, if somebody's refinancing and they're really hoping for a certain rate, you can wait for a while. And I am all for that. Like, I feel like rates are going to continue to head down right now. I'm not in any rush to lock somebody in. But in the average purchase situation, the difference, you know, a lot of time the payment is not impacted as much as people realize by the interest rate, and whether or not they can brag about their interest rate at a dinner party is less important these days since we aren't having those. So it's, I think we just need to, again, focus on what is important. Can I make my payment? Is this our home? That's what you're buying. You're buying a home, you know? So the investment part is a beautiful plus, but can I afford my home and how am I going to pay for it? That's really what we're focused on. Have those conversations with every borrower. That's what I do. I have those, it doesn't matter whether it's jumbo or anything. It's like, can we get this done and can you be comfortable afterwards?
All right. Well, any parting last words of wisdom from our mortgage gurus today?
Call for actions. If you see anything on the mortgage world, you know, what do you call them? Red alerts in your world. You know, write your congressman. Don't let them pass these bills that won't allow foreclosures for 5 years. That will just drive mortgage rates up into the high 4s and 5s. And that's not going to serve any of us or any of our borrowers. So that would be really bad if that was to go place. And a lot of these other ones where, you know, no evictions, no any of those bills that go through, as you know, panaceic as they are, will ultimately hurt the vast majority of everybody else. They might save, you know, 5% of the population.
And just remember that these everything we're talking about today, it's all very fluid. There's a reason we're doing weekly mortgage updates, and we're doing 2 to 3 webinars a week. What?
Twice a week.
We're 2 to 3 webinars a week, but we're doing at least 1 a week in the mortgage updates because that is how quickly things are changing. And again, the good news is that things are changing for the better at the moment, for the most part. But do not think, oh, I heard it 2 weeks ago and that's still the case. You've got to double check this stuff. So stay in touch with your mortgage professionals. Make sure your information is current and accurate. And again, just be a professional. That's what we all need to be right now. It's all good. We're going to be fine. We're going to be fine.
Audrey and Kevin, thank you guys both for being our guests today, and audience, thanks for tuning in.
Thank you.
Thank you so much, Patrick. Thank you, Genevieve.
Genevieve.